Hello and welcome to our webinar following the July 12th USDA crop report. Full of surprises it was, and I guess that extended to our equipment as well. My apologies for those who are watching it live. We had some equipment failure here and some systems failure. We were able to get back up and going again, and so we recorded this. Unfortunately, once you record, it means a whole new set of steps you have to go through with compliance in order before we can release it. But we're glad that you are with us, and thank you for your patience. So I will put the disclaimer slide up here again as I talk about today's report, which was full of surprises. To me, the two big keys were a much bigger wheat production estimate than expected, and USDA number two's ability to take what looked to be a very bullish new crop soybean balance sheet and turn it bearish. Now, it was less bearish than the June report, but was certainly more bearish than what the trade expected after the acreage report on June 30th. And frankly, this was the big impetus behind today's report, was for USDA to take the stocks numbers from the quarterly stocks report on June 30th and the acreage numbers from the acreage planting intentions acreage numbers, it's not intentions, but actually planted acres report on June 30th, and translate that into changes on the balance sheet to make it all work. And so that's what they did. So if we look at this report, we're still going to start off talking about where money flow was, because money flow was really positive going into this report. So did that minimize or reduce the amount of damage done today? I don't know, maybe, but I think once we turned sharply lower, the momentum selling algos really jumped in and magnified the move. But let's look at that. It was predominantly led by what we saw when this morning's CPI report, Consumer Price Index report. And that showed a 0.2% increase month on month for the headline CPI number, 3% year on year. Both of those numbers coming in better than expected, although the month-on-month report number was actually up from last month's 0.1%. And if we break it down, you know, we've had some reports where the headline number was trending better, but I still had a lot of concerns because it was just primarily because energy prices were going down, but I still saw strong shelter and services sectors, and shelter related to the housing and the rental market, and services related to wage inflation problems. And we just got a jobs report last Friday that was really showed the tightening jobs market once again during the month of June. So it was really a surprise and a pleasant surprise when we saw the services number come in lower than expected at 0.3% month on month, and year on year at 6.2%, better than expected. When we look at the shelter cost, that 0.4% gain month on month, 7.8% year on year, which is still high, but moving lower. So that's really encouraging. Helping us come down was a 1.7% month on month decline in natural gas, pipe natural gas prices, and then also fuel oil prices coming down as well. And then used car prices coming down 0.5% month on month after a couple months of big gains in that category. So that was the positive. Now, as we look at where the strength are, overall energy commodities were still higher, 0.8%, led by gasoline up 1%, electricity up 0.9% month on month. So those are concern areas going forward. But I think the bottom line here is, and this is the way Wall Street interpreted it, is that it shows that inflation is coming down, and Wall Street therefore believes that the Federal Reserve will be able to pivot quicker than otherwise thought. And so they're pricing in expectations, as I'll show you in a little bit, of a 25 basis point rate hike in 2 weeks, but then really no rate hikes after that, and then the rates starting to go down as we get deeper into 2024, maybe being down as much as 100 to 125 basis points by the time we get to the end of next year. So let's talk about that. First of all is, okay, now I went too far, excuse me. Okay, here's the rates that we've gone up. And now as we look at 92% odds of a 25 basis point rate 2 weeks, and looking at 4 to 4.25% by the end of next year. So significant cuts. I don't think so, but we'll see. So far, the market's been wrong for the last year and a half, really. And here's where my thinking is. The Fed is holding tight to a 2% inflation mandate. We got down our headline number to 3% today, and that's fine. We can get it there and we can hold it there, but we're quite vulnerable right now to the housing market heating back up, and we're seeing some signs of it heating back up again, and the labor market tightening. So can we get lower? Getting between 3% and 2% is where the real work is. And I simply don't think that we can get to 2% without inflicting more pain on the labor market. And if you do that, pushing unemployment rate up, causing people to be more worried about keeping their jobs, so therefore they back out of the housing market, then that takes care of that as well. But right now, the housing market, we have a shortage of consumer sentiment up, which it'll likely do after this report. They tend to start going back in and looking for houses. They've adjusted to the higher interest rate environment. And so we still haven't fixed things yet, so to speak. Now, as we move forward, we can see that the prime rate's been working its way higher with the higher interest rates. Overall, market expectations of inflation are continuing to go down, and our commodity baskets, next commodity index, is tracking with that strong correlation, 0.88. 0.92 for a 10-year correlation on the CPI versus our commodity index. That's really strong. I apologize we didn't get this updated. This should be down to 3% after today's data, but very strong correlation there. And you can see as the Fed funds rate goes up, managed money's been coming out of the commodities. Here's the WTI crude oil market, net managed money positions going down. Here's the ag space, similar trend there. Now, as we look at what's happening in the economy, we look at the banks are helping the Fed right now. That's because as interest rates go up, it leaves them more exposed, particularly when long-term rates are staying low or inverted. And so one of the ways they're coping with that is tightening their credit requirements. And here we show how banks are tightening their credit requirements for auto loans, credit card applications, large and middle size market firms, real estate loans, and the small firms as well. All of them, they're tightening their credit requirements. And that also tends to slow down the economy. So we anticipate there will be some more of that coming yet. I want to say a few brief words about Russia. On June 30th on our webinar, then we talked about the coup attempt in Russia. We're still looking at what may come out of that in the way of instability or potential actions by President Putin to try to reassert his authority and leadership within Russia, domestically as well as globally. Now, he has been pretty much shutting things down for the Ukraine Grain Initiative. That expires on Monday. There are still some talks going on, but it's generally expected it's going to stop. Now, Ukraine said today that they expect that Turkey will host talks with President Putin in Turkey next month, so they don't expect much movement out of the ports the remainder of this month or next month, and they hope that those talks will reopen the initiative once again. In fact, they'd like it to go for 2 years instead of these short-term intervals. So we'll see how that goes, but they are also prepared to move forward if those talks are not fruitful with a plan with cooperation from Turkey and the United Nations to go forward without Russia. The question then, will Russia allow that to happen, or will Russia do something to create fear in the shippers so that they're afraid to participate? And that's based partially on the fact that we saw Russia attack one of the ports, grain facilities at Odessa earlier this week, with reports of 28 or 29 drones attacking the facility. Reportedly, Ukraine was able to shoot down 22 of them. The damage that was done was rather minimal, shall we say, according to reports, but that's still enough to create some fear among shippers and participants. So that's a factor as well. Now, here we see what's been happening to exports trending lower with the problems, not only with the initiative, but also over land. It's generally expected. I think we have to assume at this point that Ukraine will find ways to ship wheat and corn and other commodities, but at a slower pace than what they did certainly when the initiative was working at full force, but still moving grain on. And with the big production that we're seeing in Brazil and the big wheat supply that Russia has to export, we don't see any panic situation right now in world supplies, which is another reason why we saw the sharp break in prices today. Now let's talk about weather here real quickly. And here's some of the forces. We're continuing to see a rapid building of warmth across this area, the central Atlantic, central Pacific, and that gives us an El Nino weather pattern. We also have very warm temperatures here in the central Pacific, the northern central Pacific. I'm concerned about these cool temperatures here, but so far that has not been the dominant factor. It's not really a negative PDO, as you were talking about. It's more of a negative PMM, but it can still have a factor of helping build a high pressure over the Midwest. So far, it has not been dominant. Other factors at play are the extremely warm temperatures here, as we see played out in this chart here. And basically, we've reached levels normally higher than what we see later in the year. After a summer of heating, we've already hit that level. But the one thing we've been missing is this Bermuda high that's normally in this spot. Instead, when it happens, it's clear up here and it's weaker. And so we haven't had this flow of moisture into the Midwest, but that's starting to improve right now. We're starting to get enough moisture feed in there to help feed these as we have a northwesterly flow of air coming down into the Midwest. It's encountering that moisture, and instability is coming down on those northwesterly flows. And we're getting these cluster thunderstorms. And that's what we said 2 months ago. Well, I'd say 45 days ago, and certainly in the June webinar, that's what we expected to happen to provide us our moisture. It's hard for the forecast models to pick up on those ahead of time. It does leave more of a scattered, random type of a rainfall pattern. You do get more of these strong derecho type storms and some wind damage at times, but it does provide moisture, and it also provides a milder summer, and that we are definitely seeing play out. So the weather pattern at this point is playing out pretty much as we expected 45 days ago, but it's transitioned about 3 weeks later than we expected. So we did damage to the crops during that 3-week period. So the question is now, how much can we how much can we recover? How much can we heal the crops from what we did in June and recover those yields? Now, here again is a map of our major producing areas, with most of the corn and soybean belt really being in this area right here. And so that's a predominant area that we're concerned about going forward. You see here what rainfall has been over the last 30 days. This does not include today's rains here in Iowa, where they had some good rains going forward. You can see where we relate to the last 4 decades as far as rainfall. It's below average, but we've seen many years with better rainfall, with worse rainfall than this. So that's a little bit of perspective, and we're certainly milder. Here's average temperatures for the last 30 days, and obviously you would expect it to be warmer in the south and cooler in the north. And again, on the right, you see that it's cooler than average, but we've certainly seen other years that were cooler as well. But it's still overall that coolness helps reduce the stress on the crops and get by with a little bit less moisture. Looking at the next 2 weeks, we have 3 different models here. And they're all looking fairly wet over the next week. A lot of scattered thunderstorm activity over the next week. If we look at week number 2, a lot of similarity in these 3 different models. Generally, we're concerned about moisture here in the Great Lakes area. And I've been talking about that for the last 45 days as being a concern. But we're seeing overall near normal rainfall through the core of the Midwest. The European, a little bit drier in Minnesota and Iowa, parts of Kansas, but not significantly so, with a little bit of a wetter pattern in this area. And we see that same type of a factor here showing up on the GFS's weather. Now, as we look at today's numbers, here's the first slide showing the big surprises. 1.739 billion bushels of wheat. And a little bit later, I'll go a little bit more into wheat, talk about where that came from. Mostly from the winter wheat crop is where we saw the big changes. Of course, these are the first spring wheat production estimates that we've seen. But both hard red winter and soft red winter saw significant increases in production. 52 million increase for hard red winter, 20 million increase for soft red winter wheat. As we look at corn and soybeans, excuse me, we saw that USDA left their soybean yield estimate unchanged from last month. No real surprise. I had put in a 51 bushel yield estimate, but I had stated in my commentary that I thought there was a pretty good chance USDA would not change their soybean yield, but I thought that they would change their corn yield, and my estimate was 177, and they were pretty close to that. You see here the production estimates that resulted from that, with, of course, 4 million fewer soybean acres and 2 million more corn acres. If we look at ending stocks, here's where the big surprises started. First of all, with corn, came in a little bit lower than what the trade expected and down 50 million from last month on corn. We'll go into where that came from a little bit later. Wheat, this is old crop, so no change here because we already got the stocks report on June 30th, so USDA simply solved for that number. Soybeans, 255 million. That is certainly, 23 million more than what the trade was expected. It was 25 million more than last month. We were looking for 209 million for old crop, and I'll go into the details on that a little bit later. I was looking for 1.5 billion on corn, and again, we'll go into those details. New crop ending stocks. This is another big surprise area, especially for this soybean coming in at 300 million bushels. The trade was looking for 199 million. I was looking for 189, so just a little bit lower than the trade. That's down from 350 last month, but not down near as much as what was anticipated by the market. So we look at global stocks, the wheat number coming in almost exactly where my estimate was at. Corn continues to be less than where I'm at, and that's largely because of my numbers where I believe that USDA is too high on their demand estimates for U.S. corn for the new marketing year. That's where most of that difference is right there. When we look at soybeans, today's numbers certainly coming in lower than what was, lower than what was anticipated as well. Now, as we look at the corn condition index numbers, we see that Missouri, which has largely been dry over the last month, has the lowest condition scores of anyone in the country right now. Illinois also lacking really all the way through this area, through the Midwest. If we look at the condition index score, which takes into account good, excellent, fair, poor, very poor, all of those things, a 500 would be a perfect crop, which we're sitting right here now at about a 347, I believe is what it is for this week. This shows all the years on record what the index score was for this week of the year in each of those years versus the final yield, which we see a trend yield in here then, and see where we came out relative to trend yield in each of those years. And you know, the correlation is still weak, but it's starting to improve on this. Now, my seasonally adjusted yield model is at 171.7. My experience as an agronomist tells me we're probably closer to 177. That's what I submitted for this report, in which USDA came down to 177.5, so very close there. But frankly, it comes back to the fact that we stressed the corn crop when it was setting the maximum girth or rows around how many rows of kernels you could have on that year. So we've maxed that out and maybe restricted it somewhat. So the next step is pollination, getting good pollination. And it looks like the weather is going to be generally good for pollination here over the next few weeks. Then it comes down to grain fill. And there's two aspects of that. Typically we have tip back, and that's where the end of the ear tends to abort kernels. How, and if you encounter stress, it will abort more kernels, leave greater tip back. That reduces yield. But if there's no stress, it can fill those kernels out all the way to the end of the ear. And that's one way you could make up for the loss of rows, is by longer rows from that standpoint, not tipping back. The other way is if we're cool and without stress, is we can get greater depth of kernel, longer kernels, so to speak. So you have fewer kernels per bushel, meaning the same number of kernels makes more bushels, increase higher yield. So those are the ways you can make up yield. And I anticipate we're going to do some of that. So how the pluses and minuses all come together is what gives us our final yield. And right now, my gut tells me, based on my experience of walking many cornfields, probably somewhere around that 177 area. So that's what I used on my balance sheet. Now, we'll be doing our customer survey on August 1st or thereabouts, and see what our customers are telling us. And the crop will be, on the backside of pollination by that time. And we'll continue that survey each month through November then to give a better feel. Now, one of my concerns is export demand, and we finally saw USDA come down to where I felt like export sales for old crop are in this morning's report. And I actually went about 25 million below where I'm at for exports. But what they've still got a very high new crop export target. Look where we are in new crop exports right now relative to normal, relative to average. Now, typically we tend to start really picking up the pace now, so we really need to see that happen. But frankly, when I talk to our people in Brazil, they talk about how they have so much corn flowing out, just overrun with corn right now, and soybeans in Brazil, and basis very weak. I think it's going to be very hard for the United States to compete on a new crop basis for several months here for a while. And that could be a real problem. Remember, they've only harvested a little over a quarter of their crop in Brazil right now. So they've got a lot of corn yet to hit the market. And something similar on new crop soybean sales as well, really lagging behind where we would normally be. So keep that in mind as we move on to the balance sheets. Export shipments very slow now with corn, and why USDA finally made the decision to make another big cut there, getting more in line, and then we'll see if we can recover this at all going forward. So as we look at our balance sheet, and here again, right here in this column is USDA's current marketing year that ends on August 31st, their balance sheet. And they're saying that we're going to finish the year with 1.402 billion bushels of corn, which becomes the beginning stocks for the new crop that starts September 1. Then what they're doing with 94.1 million acres, harvested acres at 86.3 and a yield of 177.5, that produces 15.32 billion bushels. You add in imports, gives you a total supply of 16.747 billion. Feed usage at 5.65 billion. Now, we go back to old crop. The March and June stocks report suggested that we were feeding more corn than what USDA said. I've been saying all year long that they're understating old crop corn feeding. So they did jump it up, but they jumped it up more, about 100 million bushels more than what I did where I had it. And I think that's partially because the stocks are coming in light because last year's crop was also smaller than what they estimated. But they hate to reduce the size of the previous year crop until we get to the next harvest. On September 30th, I look for them to cut about 100 million bushels off of last year's crop. So I've gone ahead and I've done that, leaving my feed usage number now at 5.325 billion, where I've had it for a while, by cutting the size of the crop. And that generally gives me 100 million bushel smaller supply, but a smaller feed usage number. Then we go through my ethanol number that came closer to me. I'm still about 10 million bushels less than USDA there, but they moved in my direction. Exports, they moved in my direction. but went 25 million bushels smaller than where I'm at. And in the end, my ending stocks are a little bit tighter than them at 1.387 billion bushels. Why is that important? Because that becomes our beginning supplies for the new marketing year, where USDA added the 2.1 million acres, planted acres. So in doing so, they were able to offset the added production by cutting yield and by cutting old crop supplies. And so that means a smaller carryover into the new marketing year. So their ending stocks estimate at 2.262 billion is very close to where they were last month, and the same for my 2.479. So why is mine bigger than what theirs is? Well, first of all, my feed usage number is 100 million less, and my exports for the coming year are 275 million bushels less. And when we look at the supplies that are in Brazil, the currency exchange rates, and the poor corn demand in China, it's really hard for me to see us exporting 2.1 billion bushels of corn. Extremely hard. And I'm working that through my spreadsheets. That's a global spreadsheet with all the countries involved on it. Now, the one thing that could turn that around is if we have a major crop failure in China, and El Nino is giving them havoc. They have areas that are too dry, too hot, too wet. They're having a mess of weather over there. So far, we don't see any indications that that's having a major impact on yield, but that is still very possible and something that we need to keep track of and we need to follow. But their first choice of markets is going to be to go to Brazil and Argentina. Of course, Argentina has a short crop this year, so Brazil. And then beyond that, come back here if Ukraine doesn't have enough or whatever. But that's something that we're watching going forward. Now, let's talk about soybeans. Again, the poorest condition scores are right here in Missouri and this alleyway that we see going up into Michigan. We look at condition index scores relative to final yield. You see 1992, again, had an above trend yield. But other than that, the yields really struggle with the low condition scores this time of year. As we look at, and I showed this on June 30th, we still look for crush to continue to go higher, and we see that stronger demand going forward. If we look at where that's coming from, the demand for the renewable diesel leaning heavily on soybean oil and on canola oil. I'm not going to spend a lot of time on this since we talked about this June 30th, but these crush numbers are important. This is basically growth in crush capacity. And I think these crush plants are going to try to go as close to this as we can, factoring in normal maintenance, downtime, et cetera, that they get during the year. Soybean shipments have been below the seasonal pace needed to hit USDA's target now for a number of weeks. That's why USDA came down on its old crop exports, and new crop exports, I think, are going to really struggle as well going forward. Same type of a layout here as what we saw with corn. USDA now putting old crop ending stocks at 255 million, which become their beginning stocks for the new marketing year. 83.5 million acres planted. That's down 4 million. I do expect that number to go up probably by September, but for now, this is what we're going to be trading. A yield of 52. I'm at 51 right now. My yield model's at 49.4. My agronomist experience in me tells me, depending on how we play out this season, it will probably end up somewhere between 49.5 and 50.5. But we'll see. There's a lot of variability there. That's why I'm not going lower yet, because I want to see how the weather pattern plays out in the weeks ahead. I do think that we're going to be importing more soybeans in the coming year. Crush, USDA, I believe, is understating crush by 75 million. When we look at exports, I believe they're overstating exports by 75 million, so that offsets. So our usage estimate is only about 10 million bushels different from the USDA. But ending stocks with all those other things in there are much different. I'm much tighter than what USDA is. going forward. Now, as we look at wheat, we see that the poorest ratings again right here in Kansas, where we've been seeing it throughout the year. As we look at hard red spring, South Dakota, really the entire Dakotas have been under stress and creating problems. And we may see those production estimates come lower as well. As we look at today's higher winter wheat production estimates, one of the things I looked at, what happened to harvested acreage? Well, right here was the big adjustment, up 450,000 in Oklahoma. Now, we did see decreases in Kansas and Nebraska, and we saw some adjustments here in the soft red winter wheat belt as well, but those were the big ones. As we look at yield changes here, look, Kansas yield going up, I'm sorry, this is total production, 16.6 million bushel increase in Kansas, 16.5 million bushel increase in Oklahoma. And you can see adjustments elsewhere. Those were the big things. I guess I was intending to put a yield change in there, but basically we saw several bushel per acre yield increases in the central and southern plains. We look at wheat, USDA coming in with the much bigger new crop estimate. Mine is a little bit smaller because I have a smaller harvested acreage number. So while USDA bumped Oklahoma's harvested acreage, I think when they take a look at it all in the small grain summary report on September 30th, we're going to see some more net decreases in harvested acres. We'll see, but I factored that in, Ray. So I have a little smaller production estimate. My usage estimate is very close to USDA on exports and a little bit smaller on feed usage. I was glad to see USDA finally acknowledge our feed usage patterns for last year's crop and bump up this year's, but I think they bumped up maybe a little bit too high this year, but we'll see. So in the end, our ending stocks numbers, very similar overall. Now, the focus is on the northern plains and where we end up affecting the total yield estimate going forward. Right now, this is where I'm at, and no big changes there. So here's kind of the summary of today, the take-home points. USDA flipped a bullish soybean balance sheet bearish, one of the big surprises today. Number two surprise was the large winter wheat crop. And corn was bearish, period, regardless. I didn't see us anyway changing that today. The only thing I can really see changing that at this point would be a major flip in the weather pattern here in the United States back to hot and dry, and or a total collapse of the Chinese crop. Both are possible, just not likely right now, but those are things to keep your eye on. But corn was kind of being held up by soybeans and wheat, and today's report kind of pulled the rug out from underneath of that. Now, the new crop demand estimates, those are just kind of placeholders for now. So those will be adjusted going forward, but probably not for a while. So it'll take some money. Excuse me. Now, it's all about yield the next 45 to 60 days. That is going to be, and that means weather. Watch the weather. If it's going to stay mild, we'll probably have periodic bouts of heat, but not significant heat is expected at this point. Basically, the longer-term pattern expected to be rather mild, below normal temperatures on average as we go through July and August, maybe a warm September to help finish out the crop. I hear weather forecasters talk 1992. Having said that, I still do not see the same yield response at this point as what we got in 1992, but we are moving into a similar weather pattern. That's one of the analog years for us. Soybean domestic demand is outperforming USDA. Exports are not. Exports for corn and soybeans are both really hurting. Look for more corn and soybean demand and stocks adjustments revolving around the September 30th quarterly stocks reports, but that's going to take a while. In the meantime, this is what we're going to trade. These are the numbers that we're going to trade, that the market's going to trade. Now, I do want to put in a shameless plug for our Farm Advantage app. If you haven't tried it out, it's a free app to use. There are some premium services on it, but there's a lot you can get on it that is free for your use, including getting access to my commentary, getting local cash bids, getting delayed market quotes, getting local weather down to your field from BAM Weather. A lot of great features in here. I call it in several apps within an app. Try it out. Go to farmadvantage.com or to your local app store. So that kind of concludes my comments for today. Unfortunately, since we recorded this, I can't take your questions, and I do regret that and apologize for that. But what you can do is reach out to me on Twitter. You see my Twitter address there, and direct message me on Twitter, and I can try to respond to your questions if you have any. And I look forward to seeing you again in August, when I expect another active report with perhaps lots of fireworks, depending on where USDA's production estimates come out. I do not expect them to really do much with the new crop demand estimates, but I do think we'll see some more changes in the old crop demand estimates with that report. And in the meantime, be safe out there, and I look forward to seeing you again in August for that report. So thank you very much.